Welcome to 2025. Mum and dad investors get low interest rates, tax advantages, and a smug look at Sunday brunch, while first home buyers get a lower KiwiSaver and heartbreak. Friend of the show, Calvin Davidson, returns with his latest CoreLogic report. So the question is, are first home buyers being outplayed?
Financial freedom faster. Financial freedom faster.
If you like making money rather than watching everyone else do it, hit that subscribe button and get ahead, because more people are watching this property channel in 2025 than any other New Zealand show. Calvin, are we just witnessing the greatest family feud since Cain outbid Abel with a 20% deposit and cash unconditional?
Well, certainly at the moment we're seeing market share shift around for first-home buyers and mortgage investors. We've seen first-home buyers market share come down from sort of 26, 27% over the past couple of years down to about sort of 25 in the last few months. Now, at the same time, mortgage investors market share has gone up. So they troughed about 21% and they're back up to 23. So yeah, in some senses, if people are looking at that number, they might be thinking, oh no, here we go again, the poor old first home buyer being squeezed out by investors. Now, if you look at market share, that may well be slightly true, but what that doesn't cover is the number of purchases. And in a busier overall housing market, even if first home buyers market share is going down, which it is, if you look at the number of deals, they're still buying more properties. So there are more properties now, more purchases going to first home buyers than there were last year, even though their market shares come down. So it's, I guess, a smaller share of a bigger pie is really what's going on for first home buyers. And at the same time, mortgage investors, their market share is going up in a rising market, so they're doing more deals as well. So I think it's very important at all times, but certainly this year, to look at both market share and number of deals. And we can certainly see that it's going to be a busier overall market this year. Interest rates are down. That'll drive more sales. So I think everybody will do more deals this year than they did last year. More first-home buyers, more mortgage investors, more movers as well, relocating owner-occupiers. Just that the market shares will shift around a little bit. And it's possible the first-home buyers' market share will fall, like we've already seen to some extent. But it's not a panic situation because they're still buying more properties. So, yeah, I think the whole perceived battle between first-home buyers and investors is not that helpful. You know, we need more of everyone. We need more first-home buyers. We need more investors as well, because ultimately it's the investors that provide that rental stock. So, the whole sort of media beat up sometimes about first-home buyers sometimes being supposedly locked out by investors isn't that helpful. And like I say, we need both of them. So I think this market is a bit more normal, what we're seeing this year. Everybody doing more deals, and that's off the back of lower interest rates.
Let's talk about the listings volume and the trends the last 12 months and 3 months. What's going on there?
Yeah, so listings are still very high. It's still very much a buyer's market. The flow of new listings coming to market this year, week to week, day to day, hasn't been crazy. It's just been pretty normal. And at the other end of the pipeline, sales activity has been rising as well. So I guess that new property coming on, there's a steady flow of that. There's a steady flow of property, I guess, leaving the pipeline through having been sold. But in the meantime, the sort of meat in the middle of the sandwich, I guess, is that stock of inventory sitting on the market. And it's not really changing much at the moment because those inflows and outflows are sort of relatively even. But it got very high last year. So pretty much we're still in a market where inventory is high. It's at multi-year highs, depending on the measure you look at, depending on which data provider. It's something like at a decade high. So there are a lot of listings out there. Now, some might be stale, of course, because people might have looked at it a couple of times and decided, you know what, that's not for me. Maybe the vendor's not budging on price, so it's kind of sitting there. So some of it might be stale, but that's always to some extent true. So I think the bigger picture is there hasn't been a flood of new listings, but we've still got a lot of existing listings on the market because of that previous upswing over the past couple of years. So still a lot of stock. Buyers have a lot of choice, not rushed in terms of deals. Prices, of course, are down still sort of about 16% from the peak. So, yeah, in that kind of market, buyers will either be getting a great deal, getting more property or a better property than what they thought for the same money, or getting that same property at a cheaper price. So, it's certainly a buyer's market, and it's hard to see that necessarily turning around too quickly because listings are so high, and we're still seeing a fairly soft economy. So things shifting a little bit more towards sellers, but not much. I think it's the power is still with buyers.
And property values, like you said, the value has been 16% down year on year. Is it? the prediction is still for that to go up this year?
Yeah, so that number I said, 16%, is from the peak. So if you go back to late 2021, early 22, that 16% fall is where we currently sit in terms of house prices versus that previous peak. The year-on-year number from the top of my head is something like -3. So we're still down year-on-year, but not 16%. The 16% is that cumulative fall from the peak. So that's over the course of 3.5 years. But what we've seen more recently, of course, from peak over the past 12 months, a very long time horizon. What we've seen more recently, if you look at 3 months, 6 months, that shorter time period, things have started to turn around. So our index is showed a 0.4% rise nationally in February and 0.5% rise in March. So over the first quarter of the year, we had a flat result in January as well. So over the first quarter of the year, we're up pretty much 1% in terms of property values, which isn't much. It's still pretty minor. It's early days, but certainly looks like the downturn is over and we're starting to enter that next phase. Now, still a bit patchy as well. I mean, some areas are rising more strongly than that. Some have still snuck a little bit lower, I guess. So there's always that regional variability. But we have seen, certainly in Auckland, there's signs that property values are flattening off and even starting to rise a little bit. Wellington seems to have reached a trough. Those are markets which fell a lot over the past sort of 2 or 3 years. And then areas like Dunedin and Christchurch have still been pretty resilient and still showing a little bit of growth. And they never had the same scale of falls and have probably emerged into the upturn a bit more quickly too. So, yeah, it's still a bit patchy, but I think the lagged impact of lower interest rates is coming through. We've seen that flow through to sales. Eventually that sort of flows through to prices, and I think we're seeing that now. So, yeah, 1% growth over the past couple of months, not major, but that does look like that upturn phase is here.
And the impact of interest rates, the return of interest deductibility, a lot of fixed terms coming up for renewal soon. This seems to be helping to support pushing house prices up.
Yeah, the economic story, I guess, is still part of this, and I suppose the economic news at the moment is fairly patchy. I suppose some indicators look good, some don't look quite so good. The migration story, I guess, is it's a moving feast. It's a kind of volatile indicator, I guess. There is some difficulty in trying to predict that and where migration might go. We've had a big fall in migration over the past sort of 2 or 3 years from a very high peak. So that has taken a bit of heat out of the market, but there's just signs in the past few months that might be starting to turn around. So yeah, there's a lot of uncertainty obviously out there in the economy at the moment. It's not like things are sort of soaring away or racing away or anything like that, but I guess a bit like we're seeing in the property market and a range of other things too. It does feel like the worst has passed. So we're kind of in that interesting point where maybe things aren't as bad as they were, but we're not sort of quite into that real sort of boom phase yet either. So I suppose a turning point. I got told once in my career never to pick a turning point until it's well past, because you can never be quite sure. But it does feel like we're there now. Things seem to be so just a little bit more confidence coming back. It's not sort of off the charts again, but just that sense that the things are turning around. And of course, then the tariffs have been thrown into the mix, which has been an unwelcome development. But yeah, there's if you put that aside, there is some better signs.
It's the benefit of being an economist, I guess, as you always say, with an asterisk. So I might change my opinion next week based on your information.
That's right. Yep. When the facts change, I'll change my mind. Yeah.
The lending flows in New Zealand, looks like banks are still very much wanting to lend money. And relatively speaking, we are not a nation of high debt. If you look at the total property value, 1.6 trillion in residential properties, and a very low level of lending relative to that.
Yep, that's right. Yeah. So the Reserve Bank, they produce figures on the stock of mortgage debt across the country as a whole, which top of my head is around about sort of 370 billion at the moment. And yeah, we value the stock of residential property at about 1.6 trillion. So that gives you an aggregate LVR of around that sort of 20% mark. Or in other words, there's 80% equity sitting out there now. Yep, the 80% equity is only on paper. It's you only make that cash when you sell. But yeah, that's our estimate of value at the moment. So yeah, it is relative to the value of residential property. Those debt levels are quite small. Now, of course, the problem for those people with debt is that the debt levels might be quite high on an individual basis. So I guess if you look at it from a risk perspective, yes, across the economy as a whole, across the mortgage market as a whole, there doesn't seem to be a lot of risk there, but it's quite concentrated amongst a smaller number of households. So particularly, obviously, first-time buyers, new investors taking on a lot of debt at the start. There's a bit of risk concentrated there, but generally across the economy as a whole, and I guess across the banking sector, it's all looking pretty robust. There's a lot of equity out there, at least on paper.
Just a reminder, your competition has already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart and subscribe. So, Kelvin, looking at the OCR predictions, guessing with, like you said, these tariff changes, we're seeing some economists change their position and lower their expectations of where OCR might get to this year. Any thoughts on it?
Yeah, I mean, $1 million question. I guess I suppose there's two things people have focused on with the tariffs as domestic inflation and domestic kind of economic activity. It's the standard things. It's inflation and GDP, and I guess the inflation impact might not be that significant in New Zealand. Potentially, there's a lot of uncertainty here. Like you said, I'm an economist, I can put an asterisk beside it and say, well, might change my mind in the future. But right now, it doesn't seem like the inflation impact will be particularly great. On one hand, yes, we might end up with a lower currency out of this. It looks like in the early stages we've actually got a stronger currency. But to the extent that we end up with a lower currency, yes, that might mean a bit more imported inflation potentially, as it costs more to get those goods into New Zealand. But at the same time, we might end up with more goods, as you imagine. Maybe China diverts some of their goods away from the US and towards New Zealand. So yes, there might be a currency effect, but also there's a price effect in terms of more abundant imports. So it's not necessarily clear cut that we'll end up with more inflation out of this. So that's a bit neutral at the moment. But I think the thing is, when you look at the real economy, when you look at GDP, there's a gut feel that this can't be good for a small exporting country. And yes, there's talk about, okay, well, we only get a 10% tariff. Other countries have got a lot more than that, and that's true. So to some extent, we might come out of this relatively okay compared to other countries, but still, in absolute terms, a tariff on our exports is going to make it less competitive. It can't be good for our economy as a whole. So you have to think that. Now, not saying this is going to cause a big fresh round of OCR cuts or anything like that, but there is a sense that there could be a sort of continued downward bias, I guess, in terms of that official cash rate. Previous estimates where OCR maybe goes to 3% in a neutral position, and maybe now it's a little bit below that, just because of that economic story and that risk that our economy performs a bit worse than what we thought. So, yeah, there's definitely there's still a downwards bias for the official cash rate, probably for mortgage rates as well. Yes. What happens offshore will influence that. Bank competitive behaviour will influence that. But at least from that official cash rate perspective and those sort of floating mortgage rates and shorter term fixed rates, you'd have to think there's a bit more downward scope to come. So, yeah, each individual will obviously be making their choices in that environment, and not an easy choice at the moment. Do you sort of try and wait for that absolute trough in terms of interest rates, or do you take a bit more certainty and lock in a bit longer? From the Reserve Bank numbers, it looks like at the moment that people are sort of putting a bet each way on that. They're keeping a bit floating, but also pushing a bit more out on a longer term fix. So, yeah, difficult and delicate decisions for people, but it does feel like overall, tariffs can't be good for our economy, and so therefore perhaps lower interest rates than what we thought.
Yeah, well, rental rates, there's a bit of a report there about them. They keep property prices lower. Obviously, you need income from rents to support the borrowing. At the moment, generally speaking, renters can't afford to pay more rent. So even though lower interest rates do help push prices up, the lower rent might help keep them lower, except maybe in Dunedin. I saw there's a bit of an outlier there.
Yep, yeah. And just like with house prices, where there's always regional variability, you see that for rents too. And Dunedin does seem to be having a growth phase at the moment, but there'd be no surprise if that did sort of peter out relatively quickly too. So there's always those things going on. And yes, if rental growth isn't coming through, then investors doing their sums may not be prepared to pay as much for properties. So that does tend to keep a lid on things. But yeah, at the same time, I guess the way we've been summing up this year ahead potentially is sort of conflicting forces. And you've kind of talked about a couple there where lower interest rates, we've seen in the past the influence that can have on house prices. And I think we're starting to see that again. But at the same time, maybe that influence is a bit more dampened this time around because of other factors such as affordability, the abundance of listings, debt to income ratio caps, which we haven't covered yet, but that's a restriction on lending, and just I suppose a more cautious view out there about the economy, about sort of rental prospects, that sort of thing. Of course, the one huge fact, I suppose there's two factors that have really tilted in favour of investors, which is the mortgage interest deductibility, now back to 100% for debt-backed investors. So, smaller tax bills, that's always going to be a help for investors. So even though rental growth isn't really there, smaller tax bill will kind of change the sums in a more favourable direction. But also, really, I think for investors, it's just, for me, it seems to be about mortgage rates. For a while there, when rental yields were 3 or 4%, mortgage rates were pushing 8% in some cases, certainly above 7%. That negative financing gap, I guess, was pretty significant and a big hurdle for people, and just means top ups out of other income, and those top ups were pretty significant, hundreds of dollars a week. So the fact now that gap is closing, I think that's the really big shift. Yes, a smaller tax bill helps, but go from a 7% mortgage rate, you might have been topping up on a standard property $400 a week, let's say. You get that mortgage rate down to 5%, and suddenly your top ups are 150 or 200, on some fairly standard assumptions. So still a bit of cash to go out the door in terms of keeping that property going, but a lot less than it was. And I think when you look through history, okay, it depends a little bit on your own personal circumstances, but when you look through the data historically, that sort of top up feels like it's going to be a lot more comfortable for more people. So I think that's really the big thing. Yes, a smaller tax bill helps, but getting those interest rates down, I suppose, is a really big factor for investors.
A reminder again, money moves fast and investors making the most of it are here. This is the fastest growing property channel in New Zealand for a reason. If you don't subscribe now, just know that someone else is already using this knowledge to make their next deal while you hesitate.